Welcome to week 3. We're going to cover chapter 7 this week, which covers optimal risky portfolios. So the chapter overview is the investment decision. That's 3 parts: capital allocation, risky versus risk-free. We covered that in the last section. Asset allocation, the construction of a risky portfolio, and of course security selection, the assets that go into that portfolio. We're also going to talk about optimal risky portfolio, the optimal risky portfolio, and the Markowitz portfolio optimization model. Markowitz, of course, the Nobel Prize winner. We're also going to cover long and short-term investing models, so let's get to it. The investment decision is a top-down process with 3 steps. You start at the top, which is the biggest decision. We covered this a little bit last week with the capital allocation line. The capital allocation decision is between the risky portfolio and a risk-free asset. So the question is, are you going to take any risk? And if you are going to take risk, how much risk are you going to take? If you don't want to take any risk at all, why wouldn't you just take the risk-free asset? In this case, it's usually treasury bills. But the risk-free asset does not generally give you a very high return. So you decide that you want to take some risk. Then you come to step 2, the asset allocation decision across broad asset classes. This is basically a decision between stocks and bonds. For you individual investors out there, we can also apply this to our own personal portfolios. Say the asset allocation would also be between, say, a house, other assets that you might own that could go up in value, art, coins, gold, etc., in addition to the stocks and bonds that are more traditional assets. So the asset allocation are all risky assets that go into the portfolio. And of course, you have the risk-free asset if you choose to hold some of it as well. Now, the third question, as we go from top down to the individual security selection, is now we've decided to put some portion of our portfolio into, say, stocks. Then we have to select those stocks. And so that's a security selection of individual assets within the asset allocation class, which is inside of our capital allocation, which is a breakdown between risk-free and risky portfolios. In the risky portion of our portfolio, we use a term. We covered this in corporate finance as well in the other course in 4108. Diversification and portfolio risk. So this is just to be a brief overview, given that you've probably already taken that course, or I hope you've taken that course. There's market risk and there's firm-specific risk. So diversification can get rid of specific firm risk. It cannot get rid of market risk. The way I explained it in class, if you had taken me as your professor, is that boats in the ocean, or boats in San Francisco Bay, if you're local here, the tide goes up and down. That's the economy. So when the tide's coming in, the economy is doing well. All boats go up. When the tide's going out, all boats go down. That's market risk. That's a risk you can't get rid of. That's a risk that every boat in the bay or every stock in your portfolio is going to face. A good economy, all stocks go up. As we saw in 2008, 2009, when the economy gets bad, all stocks went down, and they couldn't avoid the tide going out, so to speak. Now, inside that bay that's going up and down, you also have firms. Some firms can go up and some firms can go down. So you have waves inside the bay, for my analogy or my metaphor to keep playing out, of individual stocks or individual companies that can have individual fortunes that are not related to the economy. A company in the middle of an economic boom can collapse, and a company that is in an economic recession can also boom. So the individual firm can withstand some of the market risk, or it could collapse in a good market. So when we start thinking about market risk, that is the risk attributed to market-wide risk sources. I use the overall economy, but there are several others. We also call that systemic risk or systematic risk, and it's non-diversifiable. In other words, it doesn't matter which boat in the bay you're on, you're still subject to the tide of the bay. In firm-specific risk, that is the individual boat that you're on, and it can be limited by diversification. In other words, you can put a little bit of money in every boat in the bay, and you will not have any or very little risk. If one boat sinks, then you still have your money in all of the other boats. Now, of course, if we continue this metaphor to the risk-free rate, the risk-free rate would be, instead of being in boats on the bay, you simply stand on the dock. And the stand of the dock is completely safe, but you don't have any return or very little return on that position. So that's a way of looking at diversification and risk. If you want to be in the risky portfolio and be out in the bay, if you put a little bit of money into a bunch of boats, therefore, if a boat sinks, you don't have as much risk. You can diversify it away. Now, there's a chart for this. The first one is A, is all risk is firm specific, is A. And then, of course, we have the market risk on top of that. So I'm going to look here at market risk. There's a market risk. That's the tide going up and down. And then on top of that, there's risk for each firm. Now, the vertical axis here is your standard deviation, and the horizontal axis is the number of firms. So the more firms in your portfolio, fewer firms, more risk. More firms, less risk. And this is the unique risk for your particular portfolio. Now, if you do the math on this, you'll see that the average standard deviation, which is here in the vertical axis, we see that. If you only have one or two stocks in the portfolio, there's going to be wide deviation in the returns because they could be moving up and down all over the place. Whereas if you get out to 20, 30 stocks, you start to see that you become the average in the risk or the volatility, and it flattens out. And it flattens out quite a bit after about 30, 40 stocks, to where there's really not a big difference in whether you hold 30, 20, 30, 40 stocks, or whether you hold 200, 300, 400 stocks. So once you've got it diversified enough that you can diversify away the chances of one boat collapsing, which is my analogy, then you diversified pretty much enough to get rid of that portion of the risk in your portfolio. In other words, one boat collapsing won't sink your whole investment. Now, the flip side of that, of course, is risk reduction means return reduction. So if Bill Gates had taken his stock in Microsoft and diversified it away the minute he got it, then he wouldn't be nearly as rich as he is now. Same thing's true with Warren Buffett and many, many other multi-billionaires. Because they didn't diversify, their stock was the one that won. The problem with that is, unless you're Bill Gates or Larry Ellison or, Elon Musk or whoever else bet everything on one company and won, then you're better off diversifying your portfolio into several companies. As you can see from this chart, it starts to get down to 10, 12, 14, 16, 20, 30. A lot of people say 30 is the number. That's a lot of stocks to watch. I would suggest that any less than 10, you could probably diversify away. The other thing is that if you only have 10 stocks in your portfolio, they have to be 10 different types of companies. You don't want 10 different tech firms. You don't want 10 different pharmaceutical firms, because the pharmaceutical companies could all have a downturn, or the tech companies could all have a downturn. So you want a diversified portfolio if you have a small number of 10, 12, 15, 20. And if you get up to 300, 400, then you're going to always have a diversified portfolio, because there simply aren't enough companies in any sector to come up with that many stocks. Okay, so that's an introduction to portfolio diversification, and we will move on to lesson 2.